In 2026, retirees are walking into coin dealers with silver their parents left them and walking out with a tax bill they never saw coming. Here's one that happened this spring. A 64-year-old woman inherits her father's old coin collection. Pre-1965 dimes, quarters, half dollars. She doesn't count them carefully, she just knows she has a lot. Silver is running strong right now, over $81 an ounce, so she brings everything in. The dealer counts it out. She has $1,100 in face value. At today's melt price, that's roughly $63,000. She takes the check, walks out feeling good about it. 3 weeks later, a letter arrives, not from the dealer, from the IRS. Because she crossed $1,000 in face value in a single transaction, federal law required the dealer to file Form 1099-B, reporting her $63,000 sale directly to the government. She had no idea that threshold existed. She thought the reporting rules were based on how much the silver was worth, not the number stamped on the coin. 6 months after that, the IRS sends a second letter, a CP 2000 notice. They're proposing a tax bill of $17,640 plus penalties and interest. The reason? She cannot prove what her father originally paid for those coins decades ago. So the IRS is treating her entire $63,000 as taxable gain and applying the 28% collectibles rate. She didn't cheat. She didn't hide anything. She made one transaction. One. And because she sold $1,100 face value instead of $900, her tax bill is nearly $20,000. That is the junk silver face value trap. And in May 2026, it is catching thousands of retirees across America who inherited pre-1965 silver coins and never knew the IRS uses stamped face value, not melt value, not weight, not what the dealer actually paid them, to determine whether your sale gets reported to the federal government. This is Recession Warnings, and before this video ends, you will know the exact face value threshold, the 28% tax that applies regardless of where you sell, the cash payment trap that triggers a completely separate federal report, and the one mistake that turns a tax error into a federal crime with prison time attached. If you inherited silver from a parent or grandparent, or if you've been quietly accumulating pre-1965 coins as a hedge, this video is the most important 15 minutes you'll spend this month. Let's start with the single most critical fact about junk silver that every retiree needs to understand before approaching a dealer. Junk silver is taxed based on melt value, but it is reported to the IRS based on face value. Those are two completely different numbers, and confusing them is exactly what's costing people 5 figures right now. Here's what junk silver actually is. Pre-1965 United States dimes, quarters, and half dollars. Coins minted before the U.S. government switched to cheaper metal contain 90% pure silver. They're called junk silver not because they're low quality, but because they have no rare numismatic value above their silver content. They're worth what the silver in them is worth. Nothing more, nothing less. A silver quarter has a face value of 25 cents. But that same quarter contains approximately 0.18 troy ounces of pure silver. At $81 per ounce, its actual market value is around $14.50. The stamped number says 25 cents. The real world says $14.50. The dealer pays you based on the real world number, but the IRS tracks your sales using the stamped number. This is where the confusion begins and where the trap is set. Under IRS Form 1099-B reporting rules, a coin dealer is required to report your sale to the federal government when you sell $1,000 or more in face value of 90% silver coins in a single transaction. Not $1,000 in melt value, not $1,000 in actual payment, $1,000 in the face value stamped on the coins themselves. $1,000 in face value equals 4,000 quarters, 10,000 dimes, or 2,000 half dollars, or any combination that adds up to $1,000 on their faces. At May 2026 silver prices, that same $1,000 in face value contains approximately 715 troy ounces of pure silver. The melt value is approximately $57,950, nearly $58,000 in silver, and the dealer is required to report it the moment you cross $1 above that face value line. Stay below $1,000 face value. Sell $999 face value, and the dealer files nothing. The IRS receives no automatic notification. The transaction is invisible to them unless you report it yourself, which you are still legally required to do. That asymmetry is exactly what makes this a trap. The threshold that triggers federal reporting is based on a number so small, $1,000 in face value, that it represents coins worth nearly $60,000 at current prices. Retirees count the money they received and assume they're fine because they didn't sell $100,000 worth of silver. They don't realize the IRS doesn't measure it that way. Now let's talk about what happens when you cross that threshold, because the reporting itself is not the problem. The problem is what the IRS does with that report when your cost basis is missing. When a dealer files Form 1099-B, they report the gross proceeds of your sale. In our example, $63,000. The IRS receives that number. They then look at your tax return to see if you reported it. If you didn't, they send a CP 2000 notice proposing to add the entire gross proceeds to your income and tax it at the collectibles rate of 28%. 28% is not the standard long-term capital gains rate. Most investments are taxed at 15 or 20% for long-term holders. Physical silver, including pre-1965 coins, is classified as a collectible under Internal Revenue Code Section 408M. Collectibles carry a maximum long-term gain rate of 28%. That higher rate applies to junk silver regardless of how long you held it, regardless of how you acquired it, and regardless of the fact that the coins were once legal U.S. currency. The tax is not calculated on face value. It is calculated on melt value. Your gain is the difference between what the dealer paid you, calculated on the silver content at spot price, and your cost basis. Your cost basis is what you or the original owner paid for the coins. This is where inherited junk silver becomes particularly dangerous. Most retirees over 60 who inherited pre-1965 silver coins received them from parents or grandparents who accumulated pocket change in the 1950s and 60s, before silver was removed from circulation. Those original owners did not keep receipts. They were saving spare change. There are no purchase records, no brokerage statements, no appraisals. When you inherit an asset, the tax code provides something called stepped-up basis under IRC Section 1014. Your cost basis in inherited property is the fair market value on the date of the original owner's death, not what they originally paid for it. This is favorable. If your father died in 2015, when silver was trading at $15 per ounce and left you $1,000 face value of junk silver, your stepped-up basis is approximately $10,125. If you sell in May 2026 for $58,000, your taxable gain is approximately $47,875, not $58,000. But you have to prove the date of death value. You need a professional appraisal, estate documents, or other evidence establishing fair market value when the decedent passed. Without that documentation, the IRS can, and in audit situations often does, assume zero basis. Zero basis means the entire gross proceeds are treated as gain. The entire $63,000 taxed at 28%. That is $17,640 in federal tax before state taxes, penalties, or interest. The woman in our opening story didn't hide anything. She simply didn't have a dated appraisal showing what those coins were worth when her father died. That missing document cost her nearly $5,000 in additional taxes on top of what she already owed. The action step here is simple and non-negotiable. If you inherited junk silver and you have not obtained a date of death appraisal, do it now. Not before you sell. Now. Contact a professional numismatist or precious metals appraiser. Have them prepare a written appraisal documenting the fair market value of the coins as of the date the original owner passed. File that appraisal with your estate records. That document is your cost basis proof. It is the difference between paying tax on your actual gain and paying tax on money you never actually made. Where are you watching from? Drop your city or state in the comments below. We want to know where Recession Warnings viewers are following from. You now know the face value threshold that triggers IRS reporting and why inherited silver without documented cost basis becomes a tax emergency. But the face value trap has two more teeth, and the second one sends people to federal prison. Let's start with the one that surprises retirees most, the cash payment trap. Form 1099-B is triggered by face value. That's the rule we just covered. But there is a second, completely separate federal reporting requirement that operates on entirely different logic. Form 8300 is triggered by cash payment above $10,000, regardless of face value, regardless of what the coins are worth, regardless of how many coins you sold. Here's how these two rules interact in a way that catches careful sellers completely off guard. You've done your homework. You have $1,300 in face value of junk silver to sell. You know the $1,000 threshold. So you plan to sell $900 face value now and $400 face value later. Smart. You stay below the 1099B trigger both times. Neither transaction results in automatic dealer reporting to the IRS. But at today's silver prices, $900 face value has a melt value of approximately $52,000. You've made a careful financial decision, and you want to hold cash, physical currency, as your payment. Maybe you don't trust electronic transfers. Maybe you want liquidity. You ask the dealer to pay you in cash. The dealer cannot legally do that without filing Form 8300. The moment a cash transaction exceeds $10,000, the dealer must report it to both the IRS and FinCEN, the Financial Crimes Enforcement Network. It doesn't matter that you stayed below the face value threshold. It doesn't matter that no 1099B is being filed. The cash payment itself triggers a separate federal report the moment it clears $10,000. And at current silver prices, $900 in face value is worth more than $50,000. The cash threshold is crossed by a factor of 5. The solution is straightforward. Accept payment by check or wire transfer. These payment methods do not trigger Form 8300 regardless of the amount. You maintain the strategic benefit of staying below the face value threshold while completely avoiding the cash reporting requirement. Check or wire, every time. Now let's talk about the line between smart tax planning and federal crime, because this is the part of junk silver management that most people get completely wrong. The legal approach to managing the face value threshold looks like this. You have $1,500 in face value. You want to avoid triggering a 1099B. You sell $900 face value in May for legitimate liquidity. You need money for home repairs. You sell the remaining $600 face value in November. You need funds before year end. Both transactions are below $1,000 face value. Neither triggers dealer reporting. You report both sales on your tax return with accurate cost basis and gain calculations. You pay the tax you owe. That is legal tax planning. The illegal approach looks like this. You have $1,200 face value. You split it into two $600 transactions on consecutive days, specifically to stay under the reporting threshold, and you plan to report neither sale on your tax return. That is structuring, and it is a federal crime under 31 U.S.C. Section 5324. Structuring does not require you to be hiding drug money. It does not require you to be a professional criminal. Deliberately dividing transactions to avoid reporting thresholds, combined with intent to hide the income from the IRS, is enough. The penalties include fines up to $250,000 and federal imprisonment up to 5 years. What makes this particularly dangerous in 2026 is that banks and precious metals dealers now use AI-driven transaction monitoring to flag structuring patterns. Multiple transactions just below the $1,000 face value threshold, executed within short time windows, generate suspicious activity reports filed with FinCEN automatically. You don't know it's happening. The dealer doesn't call you. A report is simply filed and routed to federal investigators. The critical factor is intent. Selling in separate transactions for legitimate reasons, cash flow timing, estate distribution, planned liquidity events, is legal. Splitting a transaction specifically to avoid a report you know is required, while planning to hide the income, is a crime. Document your reasons. Keep records of why you sold when you sold. Show a pattern of legitimate financial decision-making rather than threshold management. Now let's put the full picture together with one comparison that shows you exactly why different types of silver carry different risks. Pre-1965 junk silver triggers 1099B reporting at $1,000 face value. At today's prices, that represents nearly $58,000 in proceeds. It is taxed as a collectible at 28% maximum rate. Silver bars and rounds trigger 1099B at 1,000 troy ounces in a single transaction. At $81 per ounce, that is $81,000, also taxed at 28%. American Silver Eagles, the official U.S. government bullion coin, carry no 1099-B reporting requirement at any quantity. You can sell 10,000 Silver Eagles, and the dealer files nothing. Also taxed at 28% as collectibles. For maximum reporting privacy while staying fully compliant, Silver Eagles are the cleanest instrument. For divisibility, recognizability, and strategic face value management, pre-1965 junk silver gives you flexibility that bars and rounds do not. Now let's close with the 3 action steps every Recession Warnings viewer who owns or inherited junk silver needs to take before their next dealer visit. Action step 1. Count face value exactly. Not weight, not estimated quantity. Actual face value. Every dime is 10 cents. Every quarter is 25 cents. Every half dollar is 50 cents. Every silver dollar is $1. Add them up. Know your exact face value total before you walk into a dealer. That number determines your reporting exposure. Action step 2. Decide your threshold strategy before you go. If your total face value is under $1,000, you have no 1099-B exposure regardless. If your total is over $1,000, decide in advance whether you're splitting the transaction across time periods for legitimate planning purposes, in which case document your reasons, or whether you're selling all at once and accepting that a 1099-B will be filed. Both are legal. Only hiding the proceeds from your tax return creates a problem. Action step 3. Lock down your cost basis documentation now. If your silver was inherited, get a date of death appraisal from a credentialed numismatist. If you purchased it yourself, locate your receipts or any contemporaneous records of what you paid. Without documented cost basis, the IRS defaults to zero, and zero basis on $58,000 in proceeds at 28% is $16,240 in federal tax on money you technically never profited from. Before we close, let's address the belief that ends careers and starts audits. Some retirees assume that because these coins once circulated as U.S. currency and technically still have legal tender status, spending them or trading them at face value eliminates the tax consequence. That belief is wrong, and acting on it is tax evasion. If you trade $1,000 in face value of junk silver for a vehicle worth $58,000, you did not conduct a currency transaction. You sold a collectible asset worth $58,000 and received equivalent value in exchange. The IRS taxes you on the fair market value of what you received minus your cost basis. The stamped denomination on the coins is irrelevant to your tax obligation. Similarly, if you hand a silver quarter to a cashier and they accept it as 25 cents, you technically disposed of a collectible asset worth $14.50 in exchange for 25 cents of value. You realized a loss. In practice, nobody tracks this. Nobody prosecutes this. But the principle establishes clearly that the IRS sees these coins as collectibles, not currency, in every meaningful tax context. Fair market value governs gain and loss. Stamped denomination does not. Every number covered in this video comes from IRS instructions for Form 1099-B, specifying the $1,000 face value threshold, IRS Publication 550 confirming the 28% collectibles rate, IRS Form 8300 instructions defining the $10,000 cash reporting requirement, and Title 26 U.S. Code Section 408M classifying physical silver as a collectible for tax purposes. These are not opinions. They are the current rules as of May 2026. Here is what you now know that most silver owners in America do not. The IRS reporting threshold for junk silver is $1,000 in face value, not melt value, not weight, not proceeds. At today's prices, that threshold represents approximately $58,000 in silver. Taxation is at the 28% collectibles rate applied to your actual gain, proceeds minus documented cost basis. Inherited silver qualifies for stepped-up basis equal to fair market value on the date of the original owner's death, but only if you can prove it with documentation. Requesting cash payment above $10,000 triggers Form 8300 independently of any face value calculation. Deliberately splitting transactions to avoid reporting thresholds while planning to hide income is a federal crime. And the retirees who come out of 2026 with their silver profits intact are not the ones looking for loopholes. They're the ones who count face value, document cost basis, report every transaction, and choose payment methods that don't create secondary reporting events. You now have the full picture. If this video showed you something about junk silver that your dealer, your accountant, or your financial advisor never told you. Share it with one person who inherited old coins and doesn't know these rules yet. The information in this video is worth more than the coins in most people's safes. Subscribe to Recession Warnings and hit the notification bell, because the next video covers exactly how to calculate and document stepped-up basis for inherited precious metals, with the specific IRS proof standards that hold up in an audit. If you have inherited silver, gold, or any other collectible asset from a parent or grandparent, that video could save you from the most expensive paperwork mistake in your financial life. Know the threshold. Count the face value. Document the basis. Report accurately. This is Recession Warnings. I'll see you in the next one.